My fellow investors, welcome back to another episode of Investing on a 9 to 5 podcast with your host, the Dividend Dog. I hope you guys have had a fantastic start to your week in the world of investing. It is a Tuesday night here and got a little episode coming up for you guys. But before we dive into the portfolio update and the new ticker I want to be talking about on the podcast tonight, I wanted to give you guys all a shout out. We hit 13K followers on Twitter at the Dividend Dog. Thank you guys for hitting that follow and like button and sharing the tweets and engaging with me on Twitter. You guys are all awesome out there. And if you're not following me, you can hit the follow on Twitter at the Dividend Dog, and you can see plays that I'm getting into and just who I'm engaging with. It's a really cool community on there, and shout out to those guys. And we've also hit 3K downloads on the podcast, guys. So thank you guys once again for downloading the podcast, sharing it with your friends, showing us that you guys are liking the content that we are, putting out for you guys. So thank you guys again. So diving into the next part of the agenda is a portfolio update. So you guys know that I was into CVS. I got in at around like $69 about 5-6 months ago, I would say. And I just haven't liked the way the stock's been performing, honestly. And it's just a lot of circulation that their workers may be walking out, and who knows what could happen after that. And so I just I don't even want to deal with all of that nonsense, honestly. So I sold it. I'm just like, I completely sell it. I put it all into SCHD. I was like, all right, cool. This would be the safest place to put it. ETF and chill out. Why not? So by doing that, that has taken my SCHD shares, along with me adding a couple of shares last week of SCHD. I am now at 93 shares of SCHD, close to my 100 share goal that I planned on getting by the end of the year, that I set out with Disney, Tim, a lot of the dividend investors on Twitter. We've set a goal of having at least 100 shares, or we did a 52-week challenge. I haven't been buying it every single week, but I've been keeping up with it where I make up for my time. But been doing a great job with that. And I know that SCHD has been down. Trust me, I know it, guys. I hear it all. I know it's not being S&P. I hear you. But I'm still going to get 100 shares in this. I definitely believe in this ETF and the companies that are within it. So, and that is on my take as well. So next up on the portfolio update, a couple weeks ago, we got the Vici dividend, ticker VICI, at $49.50. So what I did was I added another basically $50 to that. So that basically put another $100 back into Vici. I'm matching that dividend. And I've been doing that over time, and it's been compounding. So that gave me an extra 4 shares. So that bumped me up to now 131 shares into Vici. So I'm looking for that stock to continuously to go down so I can continue to buy more, because I'm not looking for it to go up anytime soon with the inflation and high interest rates and all that jazz. REITs are taking a huge dump right now, but that's where you can find a lot of value. And that's leading us into our next sheriff in town, which is ticker symbol PG, Procter and Gamble. So it looks like we got Procter and Gamble. They are reporting their earnings tomorrow. I've already purchased just 1 share, and the 1 share of Procter and Gamble is at 146.26 close up today. So closing up today, you got the S&P 500 down, NASDAQ down as well a little bit, and you got Russell and Dow up. Russell looks like it's at 1%, and Dow's up 0.4. So nothing really too crazy today. Market has no idea what it wants to do, which is fine. Just create more value in the streets for us, value and dividend investors right out there, folks. Here we go. So Procter & Gamble, we all know who they are, what they do, and what they make their money. I'm sure we have seen their products in the store. They're consumer defensive. Their industry is household and personal products. Just to give you guys a little history of them out there, P&G, Procter & Gamble, they're one of the largest and most well-known consumer good companies in the world. Founded in 1837, based out in Cincinnati, Ohio. Shout out to all my Cincy boys out there. Good old Skyline Chili down in Cincy. And you got the company, they manufactures and they sells a wide range of everyday products that we use by billions of people, not just in the United States, but globally. So PG, Procter & Gamble, they have portfolio. They got Gillette, Tide, Pampers, Crest, Head and Shoulders, knees and toes. Kidding, but they do have Head and Shoulders, not knees and toes. Olay, and other things. But the reason I am really into liking and looking into the consumer staples sector, essentially, because I read an article from Fidelity, um, portfolio manager Ben Shaliva, and he believes exposure to companies that are focusing on emerging markets, such as what PG is doing there globally, they are in other countries as well, is most compelling, going to help them long term with their opportunity to grow. He says, he sees considerable room for increased consumptions of beverages, toothpaste, shampoo, and other products such as snacks, foods, in emerging markets. Now, he is a portfolio manager of the consumer staple portfolio since 2020. And he believes companies that are focused on expanding distribution in emerging markets have increased potential for consistent earnings growth, which we're always looking for, is earnings growth over time. And there's a few reasons. And he says, first, sales of consumer staples products generally scale in line with a country's per capita gross domestic product, and GDP is projected to grow faster in emerging markets than the U.S. in the next decade, he says. Second, he notes that China and India, the two biggest emerging market economies, have huge populations and faster projected growth than developed economies. And an estimated 1/3 of the world's populations today lives in emerging market city, he adds. And the third and last one, guys, is a rising standard of living and more discretionary income in emerging markets can help fuel increased demand for many everyday products that consumers in developed economies take for granted, the manager asserts. So this just tops it off here, that in emerging markets are low-key growing every single day. There's more population. Their population is booming. It's essentially is what they're saying. And companies who are positioning themselves, who already have a history of great products that they can take advantage of, that they need to survive, they're going to more likely go with that product. So this is why I'm talking about Procter & Gamble. This is only why I added one share. Now, I don't have a certain amount of shares that I'm going to get into this company off the top of my head right now. I am going to watch it for how they do after earnings tomorrow, because I do see it here on my Stock Rover fair value margin of safety, meaning that they can see it taking a step below, going down to the 131 area, which I can see that as well here. If you're looking at the charts, you can see that it could potentially go back down to, it looks like this 50 or 200 EMA, down at 134, 135 areas. So it could go there tomorrow, but that doesn't mean that it is a bad company. That means that it's just more value in the company. So just to break it down, just to go over some numbers with you guys, with Procter & Gamble, they have a PE ratio of, they're trading at 24.8. So that is below 25, and their industry is trading at 27. So I like that. Forward PE 21.3, peg forward 2.9. Now you guys know what the peg forward, we talked about it on last episode here with Amazon. Now anything below 1 is obviously you're paying really good money for it, or anything over that you have to know what you own, essentially, right? So peg forward here with Procter & Gamble's at 2.9. So that, a little expensive, but we know what we own. Earnings per share 8.3, 5-year earnings per share growth 7.6, sales 3.9%. Now, a company like Procter & Gamble, I was looking at their K10 report. Some of their risk factors, like the credit market, high inflation, and their competition is really, how can they compete in a high competitive market? You got Kimberly Clark is another competitor that's on the same aisle as Procter & Gamble when you go in the grocery store. So it's all about how they are doing that. And one thing they are doing is through R&D. Now, they spend about $2 billion a year on R&D, and this is consistent. They're really focusing right now on digital marketing and keeping the consumers engaged either through their phones, through commercials. They're even targeting, all of that stuff through your email nowadays. They're doing that through Amazon, Target, Walgreens, Walmart, TikTok, Alibaba, you name it. So they're really, really focusing on how they can keep the consumer engaged. And this is a competitive market here when you walk down in the grocery stores. Now, another reason why I like them as well is because they have some great margins. Now, high profit margins usually means that's pretty good for the business. I mean, they have a pretty highly competitive advantage. So they have a gross margin profit of a gross margin of 47.9. The industry's at 42.8. S&P 500 is at 29. So they doubling the S&P essentially. Operating margins at 22. Industry's at 15. Net margin is 17. Industry is at 10.5. Now we're going to look down here at the dividend. Obviously, we can't forget the dividend, but I wanted to show you guys what's underneath the hood of P&G and why I see some value here in the company here right before earnings here. So they have a dividend yield of 2.6%, payout ratio at 60.6%. So that means that they pay out about $3.76 per share per year, essentially. So every time you buy a share, that's $3.76 in your pocket here. So you got a dividend yield of 5.6% over 5-year average, and then with the 3-year average, you're at a 6%, and 1 year you're at a 3%. So that's just some solid dividend paying. Dividends right there. Sorry, guys, but solid dividend history there. So they're dividend aristocrat. I've been increasing it for at least the last 25 years. This is huge for dividend investors, guys. So once again, Procter and Gamble here is a household and personal product company priced at $146.26 here. So yeah, guys. This is once again one company that I'm going to be taking a look at here tomorrow after earnings, and and seeing where it goes, and if it goes down, I'm not gonna react and sell my my itty bitty one share, but I will continue to add more when I do see the opportunity. For Procter and Gamble. And guys, that's a wrap up for today's episode of Investing on a 9-to-5, where we just went over my portfolio update and the new sheriff in town, Procter and Gamble, and just did a little analysis on the company here. And then, we did a discussion once again on their earnings that are coming up. And yeah, just take a look at it, guys, and let me know what you guys think. But before we sign off, guys, thank you guys again for being here, and please subscribe to the podcast and follow us on social media, mainly Twitter, for our latest update. And when we drop our content. If you have any questions or topics you'd like for us to cover in the future episodes, or any stocks that you'd like to cover or anything like that, please do not hesitate to reach out to me. Thank you guys again for joining me on the Dividend Dog on my investing journey. Until the next time, stay vigilant, stay diversified, and keep getting those divvies, guys. I'm out. Ladies and gentlemen.